Some assets actually make you rich, and you will get to know 8 such assets in this video. So watch this video till the end as the 8th asset is preferred by many. Now let's start, but before that, this video is only made for educational purpose. You must do your own research before investing. Number 1. Cryptocurrencies. The recent news regarding DeepSeek has led to a decline in Bitcoin, BTC, and other cryptocurrency prices, mirroring the trends seen in the tech sector. However, it's important to note that these prices remain close to their recent peaks. The cryptocurrency markets are currently stabilizing near the $100,000 mark for Bitcoin. However, based on historical trends, we should anticipate that volatility will persist in the near future. As the market stabilizes following the recent rally triggered by the ETF launch, it is important for investors to prepare for potential price fluctuations driven by broader economic conditions and regulatory changes. Despite the fluctuations, the long-term perspective appears promising, as growing mainstream acceptance is reinforcing cryptocurrency's position within the financial landscape. The introduction of more conventional methods for accessing cryptocurrency, specifically through spot exchange-traded funds, is influencing the market significantly. The previous year's surge in anticipation of spot Bitcoin ETF approvals clearly illustrated the impact of investor demand via regulated avenues on price movements. With billions currently being invested in these funds, their influence on market support has significantly increased. Number 2. U.S. Growth Equities. In the past year, the Vanguard Growth ETF, VUG, has shown stronger performance compared to the Vanguard S&P 500 ETF, VO, highlighting the robustness of this asset class. I have a positive outlook on cyclical growth equities, at least for the first half of the year. This outlook is grounded in the anticipation of strengthening fundamentals and earnings performance across these asset classes as the year progresses. The financial sector is demonstrating robust year-over-year earnings growth during the ongoing earnings season. Subscribe to our channel and also press the like button to know more assets that will make you rich. Number 3. Global Equities. U.S. stocks have consistently outperformed in the markets over the past few years. Over the past 5 years, the iShares Core MSCI Total International Stock ETF, IXUS, has underperformed compared to the iShares Core S&P 500 ETF, IVV, by a significant margin. It is common for investors to receive recommendations to broaden their portfolios by including international stocks. However, this particular asset class has not contributed positively to overall performance. Should investors consider stepping away from international markets? Approximately 50% of the world's publicly traded companies are located in the United States. It appears overly confident to assume that the U.S. is the sole option for investment opportunities. Given that markets operate in cycles and predicting the performance of emerging or developed markets outside the U.S. is inherently uncertain. Number 4. Stocks that pay dividends. Despite the impressive performance of growth stocks, income continues to be an essential element of asset allocation, particularly within retirement accounts. I maintain my conviction in the potential of dividend-paying stocks, particularly those that focus on dividend growth. Investing in dividend growers has historically yielded superior returns compared to non-dividend payers. Companies that consistently increase their dividends typically exhibit robust fundamentals, including strong profitability, ample net free cash flow, and solid balance sheets. Number 5. Investing in smaller companies. The SPDR Portfolio S&P 600 Small Cap ETF, SPSM, has underperformed compared to the large cap S&P 500 over the last 5 years. A concept in investment strategy indicates that smaller companies tend to deliver better returns compared to their larger counterparts, attributed to their increased risk and potential for growth. While that may hold in certain market cycles, the performance observed in recent decades has called this perspective into question. The system is designed with this feature integrated from the outset. When considering investments in smaller companies that carry a higher risk of failure, it is essential to ensure that your anticipated rate of return reflects that increased risk. A higher expectation for returns should be factored in to align with the potential volatility of such investments. While these stocks have the potential to yield higher returns over time, it is important to recognize that this does not guarantee performance. Additionally, they may not align with every investor's risk tolerance and overall investment strategy. Number 6. Real estate investment trusts. Real estate investment trusts, REITs, are a popular investment option that allows individuals to invest in real estate without having to buy properties directly. They offer a way to diversify your portfolio and can provide a steady stream of income through dividends. It's important to consider the specific types of REITs available, such as equity, mortgage, or hybrid, and to assess their performance and risk factors before making any investment decisions. Real estate investment trusts provide a pathway for investors to benefit from income generated by property ownership, all while avoiding the complexities of managing rental properties. It is essential for them to allocate a minimum of 90% of taxable income to their shareholders. This is attractive for those focused on income, yet it's important to recognize that not all REITs possess the same categories of underlying assets. The yield can fluctuate significantly between different REITs. For instance, AGNC Investment Corporation, AGNC, a mortgage REIT that specializes in agency securities, provides a yield of 15.5%. This REIT exhibits a higher sensitivity to interest rate fluctuations compared to its peers. Conversely, Digital Realty Trust Incorporated, DLR, operates as a data center REIT, offering a yield of 2.8%. The emphasis is on growth driven by cloud computing and AI trends, which has led investors to perceive it as possessing a more stable business model. The income structure of REITs differs significantly from the contractual obligations associated with other income-generating investments, such as bonds. The market price of REITs, due to their bond-like characteristics, is generally adversely affected by increasing interest rates. Number 7. Commodities. Commodities can play a crucial role in diversifying portfolios. However, some investors may be reluctant to incorporate this asset class. Numerous investors avoid commodities due to perceptions of complexity or excessive risk, often influenced by portrayals in media like trading places. However, with the availability of ETFs, gaining exposure to this asset class is achievable through a standard brokerage account. A straightforward method to gain exposure to commodities is through the Invesco DB Commodity Index Tracking Fund, DBC. This exchange-traded fund is linked to an index that tracks futures contracts for 14 of the most actively traded physical commodities. These assets encompass oil, natural gas, gold, silver, and copper. The primary sector is dominated by energy, with agriculture following closely behind. Certain ETFs enable investors to concentrate on particular commodities like oil, gold, or silver. Beyond their function in diversification, commodities can also act as a safeguard against inflation. I maintain that gold, despite the 26% increase in 2024, remains a solid option for safeguarding against inflation and currency depreciation. Number 8. Treasury inflation-protected securities. Treasury inflation-protected securities, TIPS, are a valuable investment option designed to safeguard your purchasing power against inflation. These securities adjust their principal value based on changes in the consumer price index, ensuring that your investment maintains its value over time. They can be an effective component of a diversified portfolio, particularly in an inflationary environment. Treasury inflation-protected securities are government bonds designed to adjust their principal value in response to inflation changes. This enables buyers to maintain their purchasing power. Watch the video appearing on the left side to know the signs show a person is secretly rich yet chooses frugality. Also, subscribe to our channel to help us hit our first 10,000 subscribers goal.